Every day, millions of people spend about 100 rupees on tea and snacks without a second thought. If that same pocket change were redirected into a long-term investment, it has the mathematical potential to grow into tens of lakhs over the coming decades. There is a common assumption that building a substantial portfolio is reserved for those who start with a massive pile of upfront capital. To test that, we have to look at the reality of linear saving. If you take exactly 100 rupees and put it in a drawer every single day, you will have exactly 3,000 rupees by the end of the month. After 20 years of perfect discipline, that drawer will contain 7.3 lakh rupees. This chart shows the rigid ceiling of simple accumulation. The money sits there, but it never grows on its own. While basic saving provides a necessary safety net, linear addition lacks the velocity required to generate true, life-changing wealth. The ultra-wealthy treat their savings as active employees, assigning every rupee a second job to generate its own independent income. This is the core principle used by Warren Buffett to build one of the largest fortunes in history. He doesn't just hold capital, he puts it to work. This mechanism is compounding, a mathematical engine where your original investment generates a return, and that return is then reinvested to generate even more profit. Compounding shifts the trajectory of personal finance from simple addition to exponential multiplication, changing the rules of how money accumulates over time. This dual line graph contrasts the two models over the same 20-year period. While the linear savings line stays flat at 7.3 lakhs, the invested line curves upward, reaching approximately 36 lakh rupees. This massive difference is powered by an illustrative 12% average annual return. The rapidly widening gap you see here represents the returns on returns, money that was earned by the investment itself rather than your daily 100 rupee contribution. This effect is so powerful that Albert Einstein is frequently cited as calling compounding the eighth wonder of the world. The wealth accumulation shown on this curve is the result of the invisible momentum of the snowball effect, which builds constantly in the background. Compounding has one master variable that dictates the final outcome: time. If we extend this model by just 10 more years, the curve goes nearly vertical. In this final decade, the growth from compounding dwarfs the total amount of money you actually contributed from your pocket. In the real world, accessing this kind of return requires moving beyond a savings account and into the modern market. Most people access this growth through vehicles like mutual funds via a systematic investment plan, index funds, or ETFs. These market-linked investments carry inherent risks. Returns will fluctuate year to year based on market conditions, and these figures are illustrative examples, not guarantees. Because of that volatility, the total time spent in the market is more important than trying to time the market perfectly. Only time allows the curve to stabilize and the math to mature. If the math is this straightforward, why isn't every daily investor a multimillionaire? The process is vulnerable to human psychology. Impatience and fear often lead to emotional decisions that physically break the compounding chain. The two most common curve killers are delaying the start of your investment while waiting for a perfect time and selling everything in a panic the moment the market takes a natural dip. Other traps include chasing social media trends, investing money before building an emergency fund, and failing to maintain the consistency of the daily habit. These mistakes mathematically reset the exponential curve to zero, effectively vaporizing years of potential growth. A 36 lakh rupee portfolio is built on a foundation of extreme patience and an unbreakable commitment to a small, repetitive daily habit. Starting today with simple pocket change is mathematically superior to starting 10 years from now with a much larger sum. Long-term investing is a test of emotional discipline. You plant the financial seed today and allow the math to do the heavy lifting for the next 2 decades. How much can you commit to investing every day? Tell us in the comments if you're starting with 50 rupees, 100 rupees, or 500 rupees. Subscribe for more simplified financial education, and we'll see you in the next video.